All right, welcome to another deep dive. This time, we're looking at Carvana, that online used car place. We've got a ton of interesting stuff you guys sent in, articles, financial data. We've even got a YouTube video from a mechanic.
Sounds like a mixed bag.
It is. And our goal today is to, well, figure out if Carvana stock is, a buy or if it's a hard pass.
Yeah, should we be cruising for a bruising or ready to ride with Carvana?
Exactly. And the thing is, looking at all this material, there are some pretty strong opinions on both sides.
Oh, yeah. I mean, we've got some sources that are super bullish on Carvana, praising their, innovation, their growth. But then we've got others, well, they're waving some pretty big red flags about potential problems.
Like some serious warning signs. So to start, we've got JP Morgan.
Yeah.
They're giving Carvana like a huge thumbs up.
Yeah, they're projecting some pretty serious growth for the company and really highlighting those profit margins, which, I mean, they look pretty impressive at first glance.
They're calling them, the fastest growing auto retailer with, industry-leading profit margins.
So basically, JT Morgan's argument boils down to Carvana's their expansion, right? Like they're popping up all over the US, and that's a major driver for growth.
Right, and we see this echoed by a bunch of the other sources, too, this idea that Carvana's reach is, constantly expanding.
It is, but on the flip side, we've got Hindenburg Research. They're calling Carvana, and I quote, an accounting grift.
Okay, so not exactly subtle there.
Nope, not at all. They're suggesting that basically Carvana's built on some shaky financials and, a lot of risky subprime loans.
Okay, so subprime loans, those are the loans that are given to borrowers with, lower credit scores, people who might be a little bit more likely to default.
Right, and it's not just speculation. Hindenburg actually claims that Carvana's, they're being investigated by the SEC, the Securities and Exchange Commission, for our listeners who aren't familiar with all the financial jargon.
Oh, wow. So that's a pretty big deal. The SEC, that's the main financial watchdog in the U.S.
Exactly. And even though, the details of that investigation are still kind of under wraps, it adds a layer of uncertainty that makes it really hard to truly assess, just how healthy Carvana's finances really are.
It's like trying to figure out what's going on under the hood without being able to open it up. Right?
Exactly.
All right, so before we get too deep into this financial maze, can we just take a step back and kind of break down how Carvana actually works?
Yeah, I think that's a good idea. I mean, it's easy to get caught up in all these, accusations and financial terms, but it's important to understand their business model, right?
Okay.
Before we really start dissecting the potential risks and rewards.
So it's not just as simple as like, hopping online, picking out a used car and clicking buy.
Oh no, it's way more complicated than that. Carvana is really operating on multiple fronts. They're an online retailer, sure, but they're also a finance company and a logistics operation.
So they're not just selling cars online. They're also financing those purchases for a lot of their customers. And then they're handling all the delivery logistics as well.
Exactly. So the way it works is they buy cars from regular people like you and me. They recondition those cars and then they resell them. And often they're actually the ones financing those purchases.
So they're basically the bank too in a
Yeah.
lot of these transactions.
Yep, pretty much. And this model, it's sometimes called originate to sell.
Originate to sell. So they're originating these loans, but then they're quickly trying to sell them off to other financial institutions.
Precisely. And this is where, things start to get kind of interesting, especially when we consider those concerns raised by some of the sources we've got.
Right, because if they're relying on other companies to buy those loans, well, that makes them pretty vulnerable if those buyers suddenly get cold feet.
Exactly. And it looks like one of their main loan buyers, Ally Financial, might be having second thoughts. Yeah, several of the sources we've got mention that, they mentioned that Ally's been scaling back its purchases from Carvana.
That's not a good sign.
Nope. And in fact, there's even a quote from an Ally executive where they say they've, and I quote, pulled back pretty significantly from Carvana just this year.
Wow. So why is Ally pumping the brakes on Carvana?
Well, it seems like Ally themselves have been facing some challenges. They're reporting higher than expected delinquencies, late payments across their auto loan portfolio.
So basically, Ally's investors are getting nervous.
Right. Yeah.
They're worried about Ally's exposure to riskier loans.
Right. And unfortunately for Carvana, it seems like their loan portfolio, it leans pretty heavily towards those subprime borrowers.
Right. And that's a big problem because in the current economy, with interest rates going up, inflation still being a pain, well, there's a growing concern that those subprime auto loans they could be headed for trouble.
Yeah, I mean, people are feeling squeezed, right? It's getting harder and harder to make ends meet, and that often translates into, well, into more loan defaults.
And that would be bad news for Carvana, right?
Right.
If they're stuck holding a whole bunch of loans that people just can't repay.
Exactly.
And to add to the drama,
Mhm.
Ali's commitment to buy those Carvana loans, it expires in January 2025.
Yeah, just around the corner.
So who knows what happens after that?
It's a cliffhanger for sure,
Yeah.
and it definitely raises some questions about Carvana's, long-term financing stability. Like, what happens if they can't find someone else to buy those loans?
Right, because they can't keep those loans on their books forever.
Nope. And
Yeah.
and you know what? This is where it gets really interesting. Hindenburg Research, yeah, those guys. They're claiming that an unnamed buyer actually stepped in to purchase a huge chunk of Carvana's loans, like $800 million worth.
Oh, wow. So who is this mystery buyer?
Well, that's the million-dollar question.
Carvana's saying that it's totally separate, an unrelated third party.
Right, but Hindenburg, they dug around a bit,
Yeah.
and they're suggesting that that this mysterious buyer, it's probably a trust linked to Cerberus Capital.
Cerberus Capital. Now that name rings a bell.
It should. One of Carvana's own directors, Dan Quayle, just happens to be the chairman of global investments at Cerberus.
Whoa.
Talk about a potential conflict of interest.
Seriously. I mean, so is this a sign of confidence in Carvana, or is this like a desperate attempt to kind of mask, a growing financing crisis?
That's what we're trying to figure out. It really highlights how tough it is to separate, fact from fiction in this whole story. We've got two very different narratives playing out here.
Yeah, because on the one hand, we've got the bullish case, right, presented by firms like J.P. Morgan. They're emphasizing Carvana's, impressive growth, their profitability. But then on the other hand, we've got these serious allegations coming from Hindenburg, painting a much darker picture. Like, they're basically hinting at potential financial shenanigans.
Right. And it's important to remember that Hindenburg, they're a short seller, which means basically they profit when a company's stock price goes down.
So they've got skin in the game.
They do. So it's definitely in their best interest to paint a negative picture of Carvana. But that doesn't mean we should, dismiss their claims outright. We got to consider all perspectives, right?
Right. Weigh the evidence carefully.
Exactly. And to really understand the potential risks that Carvana's facing, we need to zoom out a bit, look at the bigger picture. The used car market, it's going through a major shift, and Carvana's right in the middle of all that upheaval.
Okay, so what are we talking about here? What's happening in the used car market that's so significant?
Well, for one thing, used car prices, they've been dropping, and we're not talking of a small dip here. According to the Manheim Price Index, they've fallen over 20% in the past 3 years.
20%. So that means a lot of people who bought used cars recently, well, they might be underwater on their loans now, meaning they owe more on the loan than the car's actually worth.
Exactly. And that's particularly concerning for Carvana because remember, they're focusing on those subprime borrowers who, well, they're more likely to default on their loans when the value of their car, suddenly takes a nosedive.
It's like a domino effect almost.
Yeah. And to make matters even worse, Fitch Ratings, they're a major credit rating agency. They're reporting that that subprime auto loan delinquencies, they're at their highest point since, get this, the 2008 financial crisis.
Oh man, that's not a good comparison. So basically, Carvana is facing like a perfect storm.
Yeah.
Right, declining used car values and this rising tide of defaults, and all of that is putting immense pressure on their financing model, especially if Ali continues to pull back and that unnamed buyer. Well, if they don't step up and fill the gap.
It's definitely a challenging environment, to say the least, and it makes you wonder, about Carvana's ability to maintain that level of profitability that they've been boasting about.
Right, because eventually those headwinds, they're going to catch up to them. Right.
Also, but to be fair, Carvana's CEO, Ernie Garcia III, he's laid out a plan, a 3-step plan, he calls it, to achieve sustained profitability. He's claiming they've made some big improvements to their unit economics, and their retail gross profit per unit, or retail GPU, it's increased like significant, over 200% since 2022.
So they're saying they're getting more efficient, squeezing more profit out of each car they sell.
That's the claim. But remember Hindenburg, those short sellers, Well, they're not buying it. They're raising some pretty serious questions about the validity of those claims of increased profitability.
Okay, so what's their argument? Are they saying that Carvana's like cooking the books?
Well, they're alleging that Carvana's engaging in some creative accounting practices, let's say.
Creative accounting, huh?
Yeah,
Yeah.
to inflate their revenue and make their profits look bigger than they actually are.
Oh, okay. So how are they doing that?
So, for instance, they claim that Carvana is shifting certain costs, like things like limited warranties, outbound logistics, even those fees for title and registration. They're shifting all of that into a different accounting category. And this practice, well, it makes their reported retail GPU look better than it really is.
So basically they're making their profits appear more impressive by kind of hiding certain expenses,
That's the gist of it.
which I mean, that doesn't sound very transparent, does it?
Transparency is definitely a concern here. And you know what? This isn't even the juiciest part of Hindenburg's investigation. They also point to a series of questionable related party transactions between Carvana and you guessed it, Drive Time.
Drive Time, the private dealership owned by the CEO's dad.
Where? That's the one.
Hold on. This is starting to feel like a soap opera or something. So you're telling me Carvana's like playing games with a company owned by the CEO's dad?
That's what Hindenburg's investigation suggests.
Okay, but how? Give me an example.
All right, so take those extended warranties that Carvana offers, right?
Yeah.
They take a commission at the time of sale, and then supposedly they have this profit sharing agreement with Drive Time based on, how those warranties perform. But Hindenburg's claiming that Drive Time is giving Carvana like extremely generous reimbursements on these warranties,
Yeah.
which allows Carvana to recognize more revenue up front.
Okay, I think I see what you're saying.
Yeah.
So basically they're kind of shifting money around to make Carvana's books look better.
Right.
But wouldn't that mean that Drive Time, the private company owned by the CEO's dad, wouldn't they be taking a hit to their own bottom line?
Exactly. And that leads to another allegation from Hindenburg. They're saying that Carvana's offloading cars to Drive Time at inflated prices just to avoid, having to mark down their own inventory.
So they're basically propping each other up.
It appears that way. And a former Carvana director even told Hindenburg that this whole practice was like, and I quote, Fight Club, something everyone knew about, but no one talked about.
Oh, wow. That's pretty damning.
Yeah, it's starting to feel less like a savvy business strategy and more like a family affair, right? Designed to enrich the Garcias at the expense of, well, everyone else.
So far what we've got is potential conflicts of interest,
Yeah.
questionable accounting practices, and even allegations of outright fraud. It's a lot to take in.
It is. And it gets even more complicated. Remember that lawsuit brought by those two pension funds?
Vaguely.
They're alleging a pump and dump scheme. They're suggesting that Carvana and Drive Time were involved in sham transactions designed to artificially boost Carvana's reported sales growth.
Okay, so this isn't just about fudging some numbers here and there. This is potentially like serious manipulation.
Right. And it's worth mentioning that Grant Thornton, Carvana's auditor, they might be playing a questionable role in all of this too.
Okay, their auditor. So this is the independent firm that's supposed to make sure Carvana's financials are accurate and above board.
At the idea, yeah.
So what's the issue with Grant Thornton?
Well, it seems they've been Carvana's auditor for over 10 years, like even before the company went public, which isn't necessarily a problem in itself, but it does raise some questions about their independence.
All right, because if they've been working with Carvana for that long, you'd think they'd be pretty cozy with the company.
Exactly. And what makes this even more concerning is that Grant Thornton, well, it seems they also have a relationship with Drive Time, the CEO's dad's company.
Wait, hold on. So the same auditor is working for both Carvana and this private company owned by the CEO's dad.
It looks that way.
That doesn't sound very independent at all.
Nope. And it definitely raises concerns about, potential conflicts of interest, especially given all those allegations of related party transactions.
Okay, so Hindenburg's basically painted this really bleak picture of Carvana's financial dealings. But we can't forget that, that Carvana is also telling a very different story, a story of innovation, of growth, a commitment to customer satisfaction.
Right. I mean, they've undeniably disrupted the traditional used car market. They're offering a more convenient and transparent way to buy and sell cars.
And they've achieved some pretty impressive growth too, right? They've become the second largest used car retailer in the U.S.
They have, and their focus on technology and customer experience, it's clearly resonating with a growing segment of consumers who are comfortable, buying big ticket items online. I mean, who wants to deal with a pushy used car salesman these days, right?
Not me.
Yeah, exactly. And don't forget about that 7-day money back guarantee they offer. I mean, that's pretty unique in the used car market.
Yeah, that's a big deal.
It gives buyers a level of comfort that you don't typically get when you're buying a used car.
So it seems like we have this classic clash of narratives here. On the one hand, Carvana's, presenting itself as this tech-savvy disruptor revolutionizing the way people buy and sell cars. And then on the other hand, we've got these troubling allegations of financial manipulation and this lack of transparency.
Yeah, it's a complex story, no doubt about it, a lot of moving parts, and it's not easy to sort of decipher what the truth is.
So this is where it gets really interesting for our listeners, right? Especially those who are trying to figure out, do I invest in Carvana or do I run for the hills?
Yeah, we've got a lot more to unpack here.
We do.
And to really understand what's going on with Carvana, we need to delve even deeper.
We do. And we'll do just that right after this.
All right, so where were we? Oh, yeah, we were talking about those dueling narratives, right? Like, is Carvana a game changer, or are they playing a dangerous game?
Right, the classic innovator versus manipulator dilemma.
Exactly. But before we get too caught up in all that financial stuff, I think it's worth taking a look at some insights from a different perspective. Remember that YouTube video you sent us, the one with the mechanic? Scotty Kilmer.
Oh yeah, Scotty Kilmer. That guy's he's a character.
He is, and he's not afraid to speak his mind.
Not at all. He seems to have like a love-hate relationship with Carvana.
He does, and I think his perspective is it's valuable here because I mean he's not a Wall Street analyst,
Well,
right?
he's a mechanic. He gets his hands dirty with cars.
Exactly, and that experience it adds another layer to our understanding of what's going on with Carvana.
Okay, so remind me, what was Scotty's take on Carvana?
Well, he starts off by saying that he's not a big Carvana fan. He thinks they charge way too much for their cars.
Okay, I remember that. He was pretty vocal about that.
Oh yeah, but then he tells this story about one of his viewers who bought a used Jeep from Carvana. And well, it turned out that Jeep needed a lot of work.
Oh yeah, that's right. The viewer ended up taking the Jeep to a Chrysler dealership to get it fixed under the Carvana warranty.
That's the one. And here's the kicker: the Chrysler dealership, they ended up doing like $10,000 worth of repairs.
$10,000. Wow.
Yeah, all covered under that Carvana warranty. They replaced the brakes, ball joints, tires, the water pump, even the power steering pump.
Okay, so even though the Jeep might have been, overpriced initially, the buyer essentially got like $10,000 worth of work done for free.
That's exactly Scotty's point. He's arguing that if you're willing to to take a bit of a gamble on potential repairs, that Carvana's warranty it might actually be a pretty good deal.
Okay, so it's like a built-in insurance policy almost.
Kind of, yeah. And it makes you think about Carvana's business model in a different light, right? Like they're not just selling cars, they're selling peace of mind, especially for those buyers who are hesitant to buy a used car without some kind of guarantee.
Right, because buying a used car, it can be a real gamble. You never know what you're going to get, right?
Exactly. And this ties back to our earlier discussion about Carvana's focus on the subprime market, right?
Right, those borrowers with lower credit scores who might be a little bit more likely to default on their loans.
Right. And those buyers, they might not have, the best credit or a lot of cash on hand. So that comprehensive warranty, it could be a major selling point for them. It might make Carvana, more appealing than a traditional used car lot where the warranty options are pretty limited.
Okay, I see what you're saying. So the warranty, it acts as a kind of insurance policy, not just for the buyer, but for Carvana too, right?
Exactly. The buyer gets, protection against those unexpected repairs, and Carvana reduces the risk of selling a car that might turn into a money pit down the road.
Right, because if a car breaks down a week after someone buys it and there's no warranty, well, that's a huge headache for Carvana, right?
A huge headache and a potential financial hit. So the warranty, it kind of makes sense for both sides.
Okay, that makes sense. But even with a generous warranty program, I mean, there are still some concerns about the quality of the cars that Carvana's selling.
Oh, for sure. And even Scotty in that same video, he pointed out that the Jeep, even after all those repairs, it still had some error codes popping up when he plugged in his diagnostic computer.
Yeah, I remember that he was talking about a body control module error, something related to the fog lamps, even though they seem to be working fine.
Right. And he called it one of those weird codes that can happen with computerized cars. It sounded like maybe it was a minor issue, but one that hadn't been, properly addressed during the reconditioning process.
Right. So it kind of makes you wonder, how thorough is Carvana's inspection process? Are they really catching everything?
That's a good question, and it brings us to another point raised by Hindenburg in their report. They're suggesting that Carvana might be, cutting corners on their reconditioning process to boost those profit margins. They interviewed a former reconditioning leader who claimed that Carvana had adopted this two-tier policy where they lowered their quality standards for what they call their economy line of cars.
Economy line.
Yeah. So instead of applying the same standards to every car, they're creating this lower quality tier of vehicles, which, I mean, they're probably selling at a lower price, but still.
Right, but the problem is they're not being upfront about it. They're not explicitly advertising an economy line to consumers.
Exactly. And what's concerning is that this alleged change in quality standards, it happened around the same time that Carvana was bragging to investors about their cost-cutting measures. They were claiming they were doing it without, sacrificing quality, but it seems like maybe that wasn't entirely true.
It's starting to feel like Carvana's playing this shell game almost.
It does. Like they're trying to balance, profitability with quality, but not being entirely upfront with investors or even with consumers about how they're doing it.
And that lack of transparency, it's a recurring theme here, isn't it? I mean, we saw it with those redacted financing agreements with Ally, and the whole SEC investigation, which is still shrouded in secrecy, and then there are those questionable related party transactions with drive time.
Yeah.
It's like, what else are they not being transparent about?
Yeah, it's a valid question. But before we, get too carried away with the negativity, I think it's worth trying to play devil's advocate for a moment here. I mean, Carvana, they're operating in a really tough industry. The used car market, it's incredibly competitive. It's affected by economic ups and downs, and consumers are increasingly demanding more online convenience, more transparent pricing. And Carvana, well, they seem to be addressing those demands head on with their tech-driven platform, their massive inventory, and that home delivery service.
Okay, yeah, that's true. I mean, they've definitely made the whole process of buying a used car a lot easier.
Right. And they've really embraced technology in a way that most traditional dealerships haven't.
Yeah, they're kind of the antithesis of the sleazy used car salesman, right?
Exactly. And there's no denying that they've achieved significant growth, right? They've captured a growing share of the market. They're the second largest used car retailer in the US, and their revenue, it's grown exponentially in recent years.
So they're clearly doing something right.
They are. Their focus on e-commerce, it's resonating with consumers who are, increasingly comfortable buying big ticket items online. And let's not forget about that 7-day money back guarantee. I mean, that's a big deal in the used car world.
It is. It's a really strong signal of confidence in their product.
Right. So on the one hand, we have a company that's shaking up an old industry, embracing technology, offering a service that consumers seem to really value.
Yeah.
But on the other hand, we have these nagging concerns about their financial practices, their relationship with drive time, and their ability to to stay profitable in a used car market that's not exactly booming right now.
Yeah. It's like they're trying to walk this tightrope, right?
Right.
Between innovation and potential potential recklessness.
Exactly. And it's a tricky situation for investors to navigate. I mean, how do you weigh the potential rewards against the potential risks?
Right. So let's try to untangle this a bit. What are the biggest concerns that keep coming up as we go through all these sources?
Well, I think the most glaring concern is Carvana's their reliance on those subprime loans. As we've discussed, the subprime auto loan market, it's showing signs of stress, right? Delinquencies are on the rise. Used car prices are falling. And this could create a really dangerous situation for Carvana if they're not able to sell off those loans quickly enough, or if those defaults start piling up.
And that takes us right back to Ally, right? Their main loan buyer. If Ally continues to reduce its purchases from Carvana, or if their commitment expires next year without a replacement, well, Carvana could be left holding a whole bunch of loans that are increasingly likely to go bad.
Exactly. And the appearance of that unnamed buyer potentially tied to Cerberus Capital and Carvana director Dan Quayle, it just adds to the uncertainty surrounding their financing model.
Right. I mean, it doesn't exactly inspire confidence if they're having to resort to these kinds of arrangements to keep those loan sales going.
Nope, not at all. And then there are those allegations of accounting manipulation, right? The shifting of costs to inflate the reported GPU, the questionable transactions with drive time. All of these factors, they cast a shadow over Carvana's reported profitability, right?
Yeah.
And they raise doubts about the long-term viability of their business model.
It's like they're trying to outrun a financial avalanche, hoping to reach the summit before it all comes crashing down.
That's a great analogy. But we can't ignore the positive trends either, even though they might be on shaky ground. I mean, they are the fastest growing auto retailer in a market that's still very fragmented.
Right. There's still a lot of room for them to grow.
Yeah.
And they've proven they can be profitable, at least for now.
True, but even that profitability is being called into question, right? Given those revelations about their accounting practices, and then we have the CEO's father, a convicted felon with a history of financial fraud, selling off massive amounts of stock. It's hard to ignore that red flag.
It's definitely a head scratcher. It makes you wonder if he knows something that we don't. So what does all of this mean for potential investors? Should they take a gamble on Carvana, or are there better opportunities elsewhere?
That's the ultimate question, isn't it? And unfortunately, there's no easy answer. I mean, this deep dive, it's uncovered a really complex and often contradictory story. We've got evidence supporting both the optimistic and the pessimistic viewpoints.
Right. It's like we've been presented with two different versions of reality almost.
It is. On the one hand, you've got the glossy, tech-driven, growth-oriented narrative that Carvana's promoting, and then there's that darker, more cynical, financially questionable narrative that's being put forward by Hindenburg Research. And the truth, well, it probably lies somewhere in between those two extremes.
So how is an investor supposed to navigate such a confusing situation? Where do they even begin?
Well, that's where things get tricky. Ultimately, deciding whether or not to invest in Carvana, it comes down to your individual risk tolerance. What are you hoping to achieve with your investment?
Okay, so let's say you're an investor who's intrigued by Carvana's potential, but also a bit wary of all those red flags that we've been discussing. What should they do?
Well, first and foremost, don't let emotions or hype, sway your judgment. Do your own research.
Yeah.
Read both the positive and the negative reports, and really scrutinize the financial data. Don't just rely on headlines or sound bites.
Right. Don't just blindly buy into the whole Carvana is the Amazon of cars hype,
Right.
or the Carvana is an accounting time bomb
That's how you
fear
have to
mongering.
dig a little deeper, form
Right.
your own conclusions.
Okay, so go beyond the surface level and try to understand the details of Carvana's business model.
Yep.
How they finance those car sales, and what's happening in the used car market as a whole.
Right. Pay close attention to those red flags, right? The potential conflicts of interest, the allegations of questionable accounting.
I'll just brush those aside.
Nope.
And don't forget about the bigger picture, right? The declining used car market, those rising subprime delinquencies, and the fact that Ali's commitment to buy Carvana's loans is set to expire next year. All of those factors could have a huge impact on Carvana's ability to stay profitable, to compete in a market that's only getting tougher.
It's a lot to consider, and remember, it's not just about crunching the numbers. It's about understanding the people involved, their motivations, their track records, and in this case, the involvement of the CEO's father with his history of financial fraud and those recent stock sales. It's a big red flag for a lot of investors.
Yeah, I mean, it makes you question whether the company's leadership is truly looking out for the best interests of its shareholders.
And that's a fundamental question that every investor should be asking themselves. You want to invest in companies that are run by people you trust, people who are transparent in their dealings, and people who are genuinely focused on creating long-term value for everyone who has a stake in the company.
Yeah. Okay, so if you're an investor who prioritizes transparency, ethical business practices, a healthy dose of skepticism, well, Carvana might not be the right fit for you.
Especially given all the uncertainty swirling around their financials, their financing arrangements, and their ability to navigate the choppy waters of the used car market.
Okay, but what if you're an investor who's willing to embrace a higher level of risk, someone who's chasing those potentially huge returns? Is Carvana worth a gamble for them?
Even for those risk takers, I would still advise caution. It's crucial to diversify your portfolio.
Right, don't put all your eggs in one basket.
Exactly. Spread your risk across multiple investments, and
Wow.
and never forget that investing in individual stocks, especially in a volatile market like used cars, it can be really risky. Don't put in more money than you can afford to lose, and be prepared for the possibility that your investment could go south.
Okay, so I think we've covered a lot of ground here. We've explored the bull case, the bear case, everything in between.
We've looked at Carvana's innovative business model, their impressive growth, their focus on making things easy for their customers, but we've also shown a light on some potentially shady stuff, right? Those allegations of financial trickery, the questionable deals with drive time, and those looming challenges in the used car market.
Right, and I think that's what makes this whole story so fascinating.
It is. It's a complex story.
So what's the final verdict? Is Carvana a stock worth betting on, or should investors steer clear?
That, my friend, is the question that every investor needs to answer for themselves. As we've discussed, there's no simple answer. It all boils down to how each investor weighs the risks and the potential rewards, how comfortable they are with uncertainty, and whether they believe in Carvana's ability to overcome those challenges that are staring them in the face. But I think we can all agree on one thing: this is a story worth watching closely.
It is.
Carvana is at a crossroads, and the choices they make in the coming months, they're going to determine whether they become, the next big success story, or just another cautionary tale.
And we'll be here to help you decipher the twists and turns along the way. We've talked a lot about Carvana's business model, the challenges they're facing, but there's one figure we haven't really dug into yet. someone whose presence kind of looms over this whole story.
You're talking about the CEO's dad, right? Ernest Garcia II.
Yeah, exactly. And it's not just because he's the founder of Drive Time, that private dealership that's been linked to those questionable deals with Carvana. It's his past, right? That felony bank fraud conviction from way back in 1990. It keeps popping up in the sources.
Yeah, it's definitely a significant piece of the puzzle. I mean, the fact that he pleaded guilty to helping a company cook its books, reporting fake income through sham transactions, it definitely raises some concerns about a potential pattern of behavior.
Right, and it's not just that one incident. I mean, the SEC, they also charged him with signing a falsified letter for the company's auditors back then.
Yeah.
So it kind of paints a picture of someone who's willing to to bend the rules, prioritize personal gain over ethical conduct.
Right, and the same concerns they're kind of echoing in the allegations surrounding Carvana, right? Like
Yeah.
the accusations of accounting manipulation, the shifting of costs, the lack of transparency in their financing arrangements, and then those suspiciously timed stock sales by Ernest Garcia II. It all adds up to a possible disregard for ethical business practices.
Yeah, it's like a textbook example of corporate governance gone wrong. It makes you question the culture at Carvana, the leadership, whether they can be trusted to act in the best interests of their shareholders.
And that's a valid concern for any investor, right? When you have these kinds of red flags swirling around a company's leadership, it's natural to question their motivations and whether their actions are truly aligned with the best interests of the company and its investors.
Okay, but let's play devil's advocate for a minute. Let's say, for argument's sake, that Carvana's business is sound. Their growth is sustainable. They really are on the path to becoming the Amazon of cars. Why would the CEO's father be selling off such massive amounts of stock?
Yeah, that's the question that keeps nagging at me. It's hard to reconcile his actions with the positive narrative that Carvana's trying to project. Those stock sales, especially after his previous history, they create a sense of unease for sure.
Right. It's almost like he's sending a message to the market, a silent warning to get out while you still can.
Maybe, but maybe we're reading too much into it. It's possible, but it's still hard to ignore those alarm bells, especially when you factor in all the other concerns that we've discussed, that subprime loan exposure, the questionable accounting practices, the uncertainty surrounding their financing in the future. It's enough to give any investor pause.
So after this whole deep dive, what's the takeaway for our listeners? What would you say to someone who's on the fence about investing in Carvana?
I'd say proceed with caution. This is not an investment for the faint of heart or for those who are uncomfortable with risk.
Yeah.
Before putting any money into Carvana, do your due diligence. Don't just rely on the hype or the fear mongering. Dig into the details of their financials. Scrutinize those accounting practices. Consider the track record of the people at the helm.
Yeah, look beyond the surface, right?
Exactly.
And don't forget to look at the broader context too. The health of the used car market, the rising delinquencies on those subprime loans, and what might happen when Allie's commitment to buy Carvana's loans, when that runs out next year.
Right. All those factors could have a massive impact on Carvana's ability to stay profitable, to compete in a market that's only getting tougher.
Okay, so I think we've pretty thoroughly explored the world of Carvana. We've seen their innovative business model, their impressive growth, their commitment to customer convenience, but we've also uncovered some pretty serious concerns about their financial dealings, their relationship with Drive Time, and that shadow cast by Ernest Garcia II's past.
It's a complex story, and it's one that investors should be watching very carefully.
They should. And if any of this has piqued your interest and you're looking for more deep dives into the world of finance and investing, be sure to visit notyouradvisor.com and subscribe to our newsletter. We've got tons of insightful content to help you navigate the ever-changing world of money.
Thanks for joining us for this deep dive.
We'll be back soon with another fascinating look at the world of business and finance. Until then, happy investing.